What's good, Kanekis? Welcome back to the channel. I hope you're all doing well. This video has been on my mind for quite some time, so I'm quite excited to get into it. It's about investing in stocks and how to evaluate stocks with confidence. Now, the metrics I will use for this one have been taken from two books: The Intelligent Investor by Benjamin Graham, who is also, well, who was Warren Buffett's mentor, and also Peter Lynch, his book on One Up on Wall Street, which is, I mean, both books are phenomenal reads. The first one, The Intelligent Investor, was recommended by Rick Rule as well. So, hey, I don't, hey, if Rick is recommending it, just take it as face value. But I'm recommending it as well. I think it's a great read. Both books are, so be sure to put them on your reading list. So I've made it easy for you guys. I've collated the key metrics to use and to keep at hand. These are metrics I use as well when investing in stocks. I only hold about 4 stocks, so not many. Year to date, I believe I'm up about 28%, which is it's pretty good considering the miners pulled back in that free crash with gold and silver prices, but still up 26%. So just to let you guys know, it still works. People say Ben Graham's methods are a bit archaic in today's market, but it still works. It still works. So these are the metrics from top to bottom. You've got the net asset value per share. This is basically the value of the company to you as a shareholder. It is its total assets minus total liabilities. It's sometimes also called total equity, so just be sure to watch out for that. Then there's the share price to net asset value per share. So this is a ratio. For Ben Graham, he defines it to be ideally less than 1.5 for a defensive buy. The next one is the PE ratio. So PE is the price to earnings ratio. When you multiply this to the net asset value per share, ideally there should be less than 22.5. So these are just targets. These are sometimes, I mean, more often than not, it ends up being higher than this because a lot of stocks are overvalued today, which is why you have the crashes, market crashes, so because they revert to their fundamental value. The next one is the free cash flow per share. Think of free cash flow as the amount of cash that a company has in the bank at any given time. Sometimes it can be negative, meaning that they're in overdraft, or it can be very positive, meaning they're stacking up cash, possibly for an acquisition. Sometimes they can even use that to pay dividends to the stockholders. The one after this is the share price to free cash flow per share. Now, this is a ratio. You want this to be ideally less than 10 because 1 divided by this value gives the expected return on cash. So the lower it is below 10, the more you can expect to get for the cash you've invested into the company. Next ratio you've got is the net debt to net asset value. Typically, this is net equity to net debt ratio, but I find it better to do it this way because you can see how much the debt can increase before it matches the net asset value. So it's sort of like the amount of leeway a company has to take on more debt. You want this to be as high as possible because if it's below 50%, it means that the company has like a 50% headroom before the net debt matches the net assets. Once you get to that point, company's cooked. That means they're basically insolvent. So even if they were to sell all of their assets, they still wouldn't be able to meet the net debt obligations. Company's cooked. I'll show you which company I have in mind for that one in this like later in the video. So the one after this is the net debt to free cash flow ratio. And once again, similar to the net debt to net asset value, this one is actually if the company can pay all of its debt with the free cash flow it has in the bank. So without having to sell off its net assets, can it pay off all its debt with the cash in the bank? So those are all the metrics. I would encourage all of you to take a screenshot of this. Honestly, just take a screenshot now because even if you were to read the two books, these are the metrics you'd see in there time and time again. So save yourself the work. I've done the work for you. You're welcome. Just take the screenshot now. Thank me later. So let's go to TradingView. TradingView is the website I use to evaluate stocks, mainly because it has the share price and also it has the balance sheet for every company. Might be wondering why I've opened up on gold. Well, it's because gold is the hurdle rate. if you aren't beating gold, what are you doing? And the funny thing is that many financial advisors haven't beaten gold since the year 2000. Gold has surpassed the performance of the Nasdaq, the S&P, and the Dow Jones Industrial Index since 2000. I think it's outperformed it by at least 2 times. So I'll explain why you should also price your stocks in gold in just a sec. So let's think of a stock that many people know, like a company maybe people know. Let's say Nike. So Nike has the stock ticker NKE. If you don't know what the stock ticker is, you can just type in the company name as well, and it will come up. Nike is listed on the New York Stock Exchange. That is its stock performance over time. You can see that price in dollars, it has come down quite a bit. It's currently at the same price as it was back in 2015. This is where the funny part is though. If you price Nike in gold, you'll see a very different chart. It is it is at the same price as it was back in 1996 if you price it in gold. So why price it in gold? Well, gold takes away the fiat illusion. As the dollar keeps being debased, naturally, the value, the price of any given good, including stocks, goes up. So gold essentially takes away that illusion. If a company is not outperforming gold, it is not producing any value, at least to the shareholders. As you can see, I mean, I don't want to do any technical analysis in this video that much, but the technical analysis in my brain is just saying this is at support and it's just about broken support. So look out below if you're, an investor in Nike. Let's head to Nike's balance sheet. This is where we'll be employing the metrics I showed you earlier. On this first page, you can see that, okay, the price to earnings ratio, the PE ratio you saw is 36.77, just quite high. Typically, you want a PE ratio that's maybe 15 or below, because really, if you think about the PE ratio, it's typically about the number of years you can expect to hold a company for until you can get all the returns on the invested capital you've put in. So 36 is quite high. So you should be expecting to hold Nike for 36 years, basically, if you're holding it that long to get your return on your cash. Do you have 36 years to wait in Nike stock? You might be trading it, but we're not talking about trading right now. We're talking about investing. Next thing you do is you head to the statements tab and then the balance sheet. The total equity, that's the net asset value I was talking about, which is the total assets minus total liabilities. And for Nike, as of Q2 2025, they have net asset value of 14.09 billion. So as soon as I see this, I then head to statistics for the shares outstanding, and it's 1.19 billion. So what you want to do, just do the calculation up here. 14.09 divided by 1.19. So Nike has a net asset value of 11.84. Now, sometimes the net asset value is also called a book value. They're very similar, but the ratio can differ a bit. So here it says it's actually below that. It's 6.59. So it's even worse. But I prefer to use net asset value because it's the value to me as a shareholder. It's quite a bit higher. It's quite a bit higher than the 63.92. So a way to think of this is if the company were to be liquidated, how much would its assets go for? This is where that next ratio comes in. Price divided by the net asset value per share ratio. What we're going to do is the 63.92 divided by the 11.84. So the price is about 5.4 times higher than its net asset value per share, which is much, much greater than the 1.5 that Ben Graham suggests for a defensive buy. The next ratio, I believe, was the PE ratio times the net asset value, which he said should be less than 22.5. And the PE ratio for Nike was 36.77, so you already know it's going to be greater than 22.5. 36.77, 435. I wouldn't touch Nike with a 10-foot pole personally, Well, we're using them as an example. By the way, they're not the company I was talking about being underwater. You, we're still coming to that. I want you to take a guess while I'm going through. Which company do you think it is? So what you want to look at next is the net debt. Ideally, you want the net debt to be negative. It means that if the company were to fall on hard times, and they had to pay off all the debts that they have on their books right now, today, at this very moment, they struggle. They struggle to do it. Like I said, this is a defensive view. We're not talking about, the growth stocks. This is just saving your capital. We're looking at saving your capital with these techniques, with these evaluations. Just defensive first. Defensive first. Next metric was the free cash flow per share. So Nike's free cash is not very high. I mean, I've seen companies with much higher free cash. Nike's is not one of them. So Nike's got 2.48 billion in free cash. So that'll be 2.48 divided by the 1.19 in the shares outstanding. So that's 2.08. So that's the floor, essentially. You wouldn't expect Nike's share price to go below this value. It has happened. I've only seen it happen once, and that was Pan American Silver. Stock is, it's absolutely flown since then. I shouldn't have sold it. I really shouldn't have sold it. I shouldn't have cashed out. But yeah, it is very rare that it happens. When it happens, that's a great buying opportunity. You should be loading up on a stock like that. But for Nike, it's so far above the 2.08 free cash flow per share that it's not even, it's negligible compared to where the price is now. Next ratio we've got is the net debt to net asset value. Now, what this ratio essentially says is how much headroom do you have with your net debt? If you were to increase the net debt by a certain amount, would you still have enough to cover if you were to sell all of your assets? So I believe the formula was 1 minus 2.94 divided by 14.09. So they've got, close to an 80% headroom. Essentially, they can increase the net debt by 80% before, they hit the net asset value. At that point, they're cooked. So the other one you really want to evaluate is the free cash flow, the net debt to free cash flow. So that's the 2.94 divided by the 2.48. And you can see that they've got less free cash. They've got less cash in the bank than the net debt. Once again, if they were to pay up, you can see that they won't be able to do it with their free cash. They would have to sell off some assets. Now, the time for the time for the company that's cooked. 3, 2, 1. It is Starbucks. It is Starbucks. Now, Starbucks, you'll look at the price chart and say, oh, well, that's not too bad. The stock is at the same price that it was since 2019. It's not too bad. If you were to price it in gold, well, now you see the real picture. Same price as it was 2000. The trend is so bad. I mean, you look at this, you're like, it's in free fall. It's in free fall since the year 2000. But why do I say the stock is underwater? Well, they're insolvent. Starbucks is insolvent. They are in big trouble. So straight away, you can see that their net asset is negative. The total liabilities is higher than the total assets. They're insolvent. You wouldn't even be able to calculate net asset value per share because it's negative. They're cooked. Net debt 21.87, free cash 2.34. Like it completely outclips their free cash flow. Price to earnings ratio 80. You just wouldn't want to touch the stock. You wouldn't want to touch it. So if you're a Starbucks lover, thoughts and prayers. But this company doesn't have much legs. It really doesn't. The thing I want to show you is this is what it essentially comes to. Like once you get these ratios up, you can put it in an Excel sheet, type the numbers in. So what you saw with the net assets, net debt, free cash flow, the shares. We haven't really talked much about the earnings per share, but there's the price to equity ratio. And then you can then look at, once you put them all in an Excel sheet, you can then look at the the numbers compared to each other. These are all the stocks I've looked at. I mean, I said I've invested in four, but I have tracked quite a few. A few I've sold out of, but the only ones I hold are the four I hold are First Majestic, AG that you see there, McEwen, Paramount Resources, and Petrobras. Now, McEwen, you might say, well, Kojo, like you said, ideally less than 22.5 and less than 1.5. Well, when I bought them, they were below that. They've just increased so much of late that they've completely blown past these limits. But I've taken profits from them, letting the rest ride. So I've been responsible. So the other thing that these two books teach you, especially Peter Lynch's One Up on Wall Street, is that price follows earnings. So when you plot the share price against the earnings, you see that the earnings typically leads the share price. What you're looking at here is all the miners. Well, the miners I've been tracking. Once again, I've only invested in two, First Majestic AG and McEwen MUX. But yeah, these are the miners. This is how they've done. Look at the earnings and the price follows. AGI earnings is above price. Eventually, price follows. First Majestic earnings, price follows. McEwen is still early. Hey, I'm not saying invest in McEwen now, but like it hasn't caught up yet. That's my speculative play. Oil and gas. Even within the oil and gas industry, Petrobras, think of it like a vacuum. The price eventually moves to meet the earnings. Paramount Resources earnings is above. Exxon, though. The price is above the earnings. So I have been kicking myself for not investing in Exxon because I was looking at it around $116 per share. It's now about 140. But the price is well above the earnings. So I don't know. I won't be surprised if I saw a pullback in Exxon's price. Watch this space. Let's keep an eye on that. But if it does pull back, best believe I'll be on that. So another one, like Chinese stocks. The one on the right is a Brazilian stock. Once again, the same thing. Price goes to meet earnings. So if you can plot earnings and price, that could give you a good way to once again gauge whether a stock is overvalued, undervalued. And yeah, that is all. I think I've done in about 20 minutes. So those are the main things I've learned from those two books. I hope you've enjoyed this video. Let me know what you think in the comments down below. Please do not use this video as as a reason to not read them. Those are phenomenal books. There are others I've talked about as well. What has government done to our money? That will help you understand why you should be pricing things in gold. So I'll make it 3 books, 3 recommendations. Benjamin Graham's The Intelligent Investor, One Up on Wall Street by Peter Lynch, and What Has Government Done to Our Money by Murray Rothbard. That's an Austrian economics book. I hope you guys have enjoyed it. Please remember, take that screenshot of the metrics. It will do you a world of good, especially if you want to just get straight into investing in stocks. I wouldn't recommend it. Invest in your education first before you put money in the stock market. And after you do that, buy some gold before you invest into the stock market. Just get the foundation right. Invest in your knowledge, buy some gold, and then invest in stocks. I hope you guys have enjoyed it, and I will see you in the next one. Peace.